Hi, it's Financial Detox. I'm Jason Labrum in studio with Alex Klingen-Smith. What's up, Alex?
How's it going, Jason?
End of year. Here we are.
Happy holidays
2024 in the books. What are we doing?
I think it's great. It's been quite a year, right? I mean, kind of an easy year for our industry in some ways. The markets have been phenomenal. And then with the election behind us now, I mean, what's there left to worry about, right?
It's going to be fun. Today, we're going to talk about a bunch of different things and just get back in front of our Financial Detox listeners and our people. And we want to go over a couple things that happened with the elections, right? That was a big deal. People were really worried about the election, regardless of what side of the aisle you are on. People were worried about it. And as usual, these events seem to be much more sensationalized in the media than what they actually turn out to be in real life, right? The world was going to end if one candidate won or the other candidate won. And here we are going along. The only thing different is we got a bunch of crazy drones flying around, right? What are the drones all about, man? What's the deal there, Alex? Do you know?
I don't know. Well, I want to talk about crypto and AI at some point today. So I want to fit that into the AI crypto conversation later, if that's okay with you.
I think so. How about the Trump bump, as they call it, with crypto? I mean, crypto's gone to 106,000 Bitcoin as of yesterday.
I was with Nolan in Newport Beach at that investment conference that you were supposed to speak at, and then you kindly let me do that instead for you. And that was really fun because I was up there on a panel with 3 other chief investment officers who are the investment minds, the brains of the investment world of their firms, right?
Yes.
One firm was maybe a little smaller than ours. One firm was quite a bit larger than ours. And the other one was quite a bit larger than ours. And then they asked all these really hard questions. But the point of the story, back to the Bitcoin thing, was the night before, we were sitting at the restaurant Marriott in Newport Beach, and crypto or Bitcoin had just hit 100,000. Right. And I was sitting with the Bitwise people, right? And they were like, drinks on us. Like, they were so excited, right? This is the first time. And I didn't even really know what was happening, but it was a pretty big moment, I guess. And Nolan was also excited because he's a millennial, right? Or maybe what's after millennial?
Gen X?
No, before
Gen Z.
Oh, Z. He's like a Z/millennial on the cusp guy. So he was ecstatic, and I had to ask him why this was important and what it meant for investing. And then the next day I got to talk about it.
Well, before we dive too deep into these things, and I think we should just start with that because it's fun, but let's remind our audience and our listeners what Financial Detox is, right? We are a consumer education brand that's designed to just talk about managing your money and how do you avoid toxic advice and how do you manage your money for maximum impact. We want to help you become financially detoxified, just like as with your health. You want to be detoxified, you want to live healthy, but financially living healthy oftentimes impacts every aspect of your life, right? It can actually impact your real health, your financial health. So we're excited to bring this show to you. It's part of an extension of our wealth management firm called IDA Wealth, where we integrate tax planning, tax returns, investment management, portfolio management, financial planning, even estate planning, alternative investments, and all that together. So I guess to pivot off of that, Alex, it's when I look at what's going on right now with Bitcoin, what is blowing my mind? I mean, completely blowing my mind, and it shouldn't because I've done this for 29 years now.
Yeah.
Is how many people are now asking me because of the headlines, should I get some Bitcoin? How much Bitcoin? I'm like, no, you should have bought it 5 years ago, right? No, why now? Why are you asking right now is what I say. And obviously it's because they've heard about it on the news. It's just crazy, the sensationalism of media and how emotions drive investor behaviors.
But there's some logic to it. So look, you say this all the time when you're speaking in front of large groups. You say people used to go to a broker to get access, to be able to trade, to get access to information that wasn't easily available. Now there's so much information everywhere that our job, we feel, is to steward true financial peace of mind, to sift through all of this information and help people make good decisions on how to invest and how to properly diversify, allocate, rebalance everything, right? Tax efficiency. So if Bitcoin is in fact a potential asset class, I'm using very if and potential because compliance would tell me, and I'm excited about it, but I still am not sold on how to properly integrate it into a portfolio, especially if we're trying to say it's good for everybody. I could see a case now, even this is what the struggle we're having internally, where there are people that have an appetite for these asset classes that are incredibly volatile, or whatever you want to call them, asset class, investment, whatever, crypto. AI. These are incredibly unknown things still, but they have an appetite for it. So rather than us tell a client, go do it on your own at Coinbase or whatever, good luck, play money, fun money, money that you lose in Vegas. Perhaps as a long-term strategy, it might be viable for those with an appetite.
Yeah.
And I'm like, okay, but then what do you do with it? Like if Trump won, doesn't he love crypto, or his vice president love crypto, Bitcoin? Is that true?
I mean, I think the reason why you saw on election night, crypto ran up 12% or something. And prior to the election, when it started looking like it was probable of a Trump victory, you saw the crypto bump, the Trump bump. It's because he's a proponent of deregulation, right? Of allowing cryptocurrency and allowing it to be deregulated, or at least allow it to be like legally used and in part of society. And so I think that's really what's driven it, is you now have an administration that's not totally against it, which is along the same themes of what the Trump administration is going to do, which is reduce government burdens, red tape, administration burdens, and, hopefully still have regulation where it's needed, but not have unnecessary regulation. So that's a really good thing. And it's really good for the world, cryptocurrency and blockchain technology, because it provides access to stable currencies. Now they're still going through their volatile, initial stages, but the concept is that the government can't manipulate the currency. The government can't manipulate it. And that is a beautiful thing for people who otherwise don't have access to safe banking and safe currency and so on and so forth.
And if Wall Street's allowed to do what Wall Street does, make money, free market capitalism through our economy. And this is another pivot, and we're finally going to get back to our core investment philosophy and what to do next year at some point. I'm sure we'll start with the outlier stuff and bring it back. But
I like it.
If you say that Wall Street over the past 5 years or so, maybe even 10, has allowed the average investor to access private alternatives, right? If they're doing that with crypto now, BlackRock came out with theirs, right? Immediately, I think it was the number one ETF ever for inflows, because it was just the first mover on Bitcoin. Now there's Ethereum based ones, there's other ones as well. Yeah. But if there's other companies that are rising up in the billions of dollars to give access to, and then more and more people are allowed to do it in a safer way, I guess you could say, where it can't get necessarily lost, or there's some sort of like safety in numbers perhaps, or, BlackRock doesn't want to have this massive exposure, and the next few people are doing it in a way where it's reliable. It's more reliable than it was, at least. Private alternatives were also something that happened in the past few years, where not just the ultra high net worth or the endowments were given access in different ways through different product structures. That's where like the future is going, whether we want it or not. How do we do that? Should we do it? In what amounts? That's where we're cautious, right? We're more cautious than most, I think.
I don't know that we are, because we have helped clients buy Bitcoin and have access to it. We are probably much more forward thinking with regards to alternative investments than most advisory firms. And certainly the average retail client has almost zero alternative investments. And by alternative investments, we mean things like private equity, private real estate, private credit, private debt, so on and so forth. What we're building is a way that we can easily and comprehensively put that together for our clients, where they can have a diversified portfolio of alternatives. And that will be a big, where we can then have an opportunity, if we say that, hey, it's right to have a 1 or 2% allocation to cryptocurrency, and we're going to own these 3 different cryptocurrencies or Bitcoin or whatever it is, blockchain technology, then we would be able to apply that across all of our client base quite easily. So I think it's cool. What I hate, and I think is wrong and not cool, is that people want it when it's at a high. Yeah. When it's hitting all-time highs, right? People want stocks. I've had otherwise really conservative clients who said, I'm really happy with a 5% rate of return. I want 5%. I don't want volatility. Those clients are now some of those clients are starting to say, man, I need more returns. And I'm like, why? Did your goals change? Your plan is totally successful. You have more money than you'll ever spend in your whole life. You're not even spending the money you could be spending, but all of a sudden you want more returns because the markets have been really good. That's scary. Like, that's wrong. That's toxic financial thinking, when you change your targeted or needed rate of return simply because rates of returns have been higher. Or you say, all of a sudden now I want Bitcoin because the returns have been really good, and you feel that fear of missing out, right? It's that human greed component. And that's pretty scary, actually.
Well, What a perfect time of year though to go back and revisit your financial plan, your goals, your financial goals, and then also kind of like put those right next to, in front of, or behind, probably behind your personal goals, like what matters to you most in life. People go through this resolution process, which I think you and I agree that it doesn't work. People like, what's the average resolution like lifespan, like a week or two or something. But if you actually set real goals that are more action based, more habit changing based to work towards accomplishing the goal, and then monitor your own progress, like a really good financial plan, for example, then you can set up a really good diversified portfolio that that mirrors your actual long-term goals, and you're not then chasing something that is unattainable anyways, unless you have really, really good luck consistently.
Best thing to do is exactly what you just said. Don't go chasing the hot dot. Have a financial plan. Know why you're trying to get the return you're trying to get. You need to know why you're trying to achieve that rate of return, and then go build the asset classes and the investments that you need to get that rate of return. The problem is when you just start putting a number out there. I need 8%. Why? Because I like 8. Okay. I like 9. Why not 12? All right. Why not 15? Why are you trying to get the rate of return you're trying to get? What else on that? I mean, crypto.
I think though, I want to stick on the resolution thing, but also, well, okay, fine. I'm going to push a little further, because I literally came back from a few of these conferences, Jason, and I'm like, man, this is why you guys kicked me off the investment committee a while ago. Because I come back and just ask all these questions, and you're like, just be quiet, man. You don't know what you're talking about. But I think I might sort of sometimes. I love what we do. Our core philosophy is
no, just kidding.
our core philosophy really does work incredibly well with market efficiencies and just the way the markets work. And then we expand out to the private alternatives, but there's innovation that is going to continue to happen in the world. And that's something that I love AI. I mean, I love it in the sense that I'm fascinated by it. I want to learn how to be more efficient as a human being.
You're good at using it too in our business. You use it all the time.
I don't know if I'm good. I'm willing to experiment. It's like a new video game for me. I used to like video games when I was a kid, not a lot, but enough to where I enjoyed getting good at it, and then I'd get bored and I'd move on. But I wouldn't get stuck on the one game. AI to me is fascinating because of the ways that it can be used. And then as an investor, a lot of our clients come to us and say, how do we invest in this? And then our typical answer, which is correct, is, well, you're already investing in it to these large companies that are buying up all these small private companies and then integrating them in for their talent base and their technology, and Microsoft and NVIDIA. You already own them. Yeah, but I'm like, okay, but what if I wanted to lean into specific like venture, like parts of AI, like before they pop and get bought at 3 or 4 or 5 or 10 rounds later? Like that would be interesting if I was an investor. Like, how do I do that? Or should I do that?
Yep. Yeah. And I mean, you said it right. It's like, how do you buy the internet? Go back to 2000, right? Or 1995 or 1990 when the internet came out, and people are like, we've got to invest in this internet thing. How do I buy the internet?
Yeah.
I don't know. Well, you don't buy the internet, but you buy companies that use that technology to do better, AKA Amazon or Google or whatnot, right? And had you bought all those when the internet came out, well, there was a lot of them that went broke, though. People don't realize that. Like, look at Netscape. Look at where's AOL. Where's Yahoo. I mean, hundreds of companies we could show that were on the initial throes of the initial stages of the internet, but they didn't end up being the ones who optimized and used that technology. I think the same thing is going to be true with AI.
Oh, for sure. It's already happening.
Yeah.
There's
you don't
like
buy AI. How do you, I'm investing in AI. Well, there's AI ETFs, but those ETFs just own Microsoft and Google and NVIDIA and all the companies that are fueling and or using AI.
And there's some that have emerged that are actually trying to get those initial venture, again, like the private companies, and do it in a private way through the access, kind of like a private alternative, and focus on AI that before it's totally proven out, which is the most dangerous kind, because maybe they say they've built this thing that works. And then when you actually go in and do due diligence, like it doesn't work, but it's too late because you've already invested all this money and the thing falls apart. That's the danger of going too early into these things before they're fully proven out. Still a topic that it's not going away. Our clients are going to continue to ask us about what we're doing in AI, how we're maybe using it as a factor or an asset class or maybe a sector. I don't even know what to call it really, right? Because it's everywhere. It's across every industry. Certain industries it's disrupting. Certain industries, I think it's accelerating in a good way, meaning that it's making it more efficient, more productive, cutting out some of the things that are unnecessary, which is a great evolution for some industries, right?
You have to have it. You have it. And all of our clients do have it in their portfolio, right?
Yeah.
AI is embedded in all of the top companies. A while ago, we pivoted to, this was more than a year ago, to factors that truly exhibit high growth. Like, because that becomes a factor or a fundamental that exists in a portfolio, where companies that exhibit really high growth or have high expected growth over multiple of years, they typically have really good stock appreciation as well. Yeah. And you're seeing that with companies like NVIDIA, and you're seeing that with all of the companies that are anywhere.
Momentum, right? That was one of them.
Momentum, just high growth, really, not even just momentum, but just high growth becomes a fundamental characteristic. But I think that, as we look to the end of the year and you talk about elections and you talk about all the Bitcoin and you talk about AI, these things are all part of a well-diversified portfolio. You got to have them. Going to chase one specific sector, when you talk about like venture capital funds, or I'm going to go buy this new company that is AI focused and it does blank, that's real risk. Like, that can go to zero.
Yes.
And that's okay. I'm not saying you shouldn't invest in it. I had friends who were early investors in Viore and the clothing company, Athleisure, and that could have gone to zero. I didn't. Some people invested, 100,000 that turned into millions and millions of dollars. So if you like taking that kind of risk, you should. And there's ways to do it with venture capital funds, technology focused venture capital funds. Yeah. Venture capital is really a pre-earnings, pre-revenue, certainly pre-profitability stage of private companies. It goes back to the thing too that we're talking about with how the public markets have just continued to shrink. Like, the number of stocks that are available to be publicly traded has continued to shrink because companies aren't really going private anymore, or aren't going public anymore, because there's so much private equity and venture capital money that those companies are going through 1, 2, 3, 4, sometimes more rounds of private equity buys the company and the innovation, they grow it, then they sell it to the bigger private equity, then they sell it to the bigger private equity. And so there's a lot of opportunity to be had in AI and in crypto and in private companies that aren't even publicly traded. So you got to have alternatives. Yep. And that private equity is part of your portfolio. If you have a decent time horizon and if you don't need 100% liquidity and access to all of your money, because there is illiquidity and there are other risks associated with investing in alternatives that are not your traditional investment risks.
Brings us back to why it's so important having an investment philosophy that you can stick with, because there's always going to be something exciting and fun, and how you deal with that's really, really important for the long term. This is the part where we get to make fun predictions, right? We did this a few years ago.
We're going to go prediction land.
I think we even bet you against me.
Get your crystal ball out. Hey, who won last year though? What's up? Who's winning?
I always win.
You do?
I don't remember.
We have them written down. We do. Where did it go?
I know. I got to go back.
Can you find it?
I actually do sincerely forget who won, because it was such a ridiculous exercise.
But I had to crush you. There's no way.
We bet on like 5 different major market indices, so maybe it was a tie. I don't know. Or
where was it? Let's go find it. Where did it?
It was pre-COVID, man. So maybe 5-6 years ago.
Oh dear. No, we did it. Didn't we do last year a prediction show? We're like really bad at predictions, by the way.
Yeah,
we need to make sure that people don't take this serious.
No. So this is for fun.
This is to actually make fun of people who predict the markets more so, because to try to predict what's going to happen in a market over 6 to 12 months with thousands of different variables impacting that is kind of a fool's errand, but we do it for fun.
Well, people ask us to do. Today, I had a meeting with the children of a client today, and they actually literally asked me what's going to happen next year. And I'm like, I refuse to answer that question. So now I'm publicly going to do it just for fun.
Okay, that's bad. Hey, listen, producer Brian, can you pull up on that client resource kit I gave you? And this is from our good friends over at First Trust. And when that comes up, we'll talk about it. But here's the deal, right? Like, predicting the markets is really tough because there's thousands of variables that affect the markets throughout the year. But I can tell you this, right? I can almost certainly guarantee that there's at least a 70% chance the markets are going to be positive if we look at next year. Because when you look at rolling 1-year periods, it's in the 70s. If we look at rolling, there you go. If you look at rolling 3-year periods, it's higher. This is a chart that's just basically showing you how the stock market fluctuates a lot. Typically, it hasn't much lately. The stock market fluctuates quite a bit, but if you look at 1-year returns, 73% of the time it's been positive. So just imagine that if you could go to Vegas and have a 73% chance of winning success, that would be epic, right? I'd just move to Vegas.
I'd probably still, if it was me.
But isn't that crazy though? You have a 73% chance of making money if you just look at 1 year periods.
Okay.
And to get people to look at 1 year periods is hard. But if you just look at least 1 year periods, when you go to 3 year periods, that goes up substantially. When you go to 5 year periods, it goes up substantially. So
I got the betting. I drew out my diagram here. So we're going to have evidence here. We're going to go plus or minus, and by what percentage number. So don't worry about the actual number of the index or the thing, right? Just put up 10% or down 10%, up 17, down, whatever.
Yeah, no, we're talking about the MSCI World Index
or Bitcoin first, just because we started with Bitcoin. What's Bitcoin going to be at the end of next year?
This is going to end up so bad.
Up what or down what? You go first.
We're saying
I'll go first if you want.
2025 total return from January 1 to December 31st.
That's very technical of you. Yes.
Okay. Well, hey,
just to get the bet correct.
I'm making a guess. I'm rubbing my crystal ball. I need to tell it the right information so it spits out.
Yeah.
Bitcoin, here's how I'm going to do it. I'm going to do it where I'm like pretending or I'm really trying to be correct. Bitcoin will be higher than it is today.
By how much?
No, I didn't say. I can't say.
I'm going to say we're going to be up 25%
in Bitcoin.
Yep.
I mean, why don't you just spin a roulette? I mean, a kaleidoscope. You're just guessing totally.
Are you scared? You're scared of the bet, huh?
Yes.
Get him, Brian. Come on.
What does producer Brian and Shayna think?
Yeah. What do you think, Shayna?
I'm gonna go Price is Right and say 30%.
Ooh! Now he wins on anything above. That's right.
You can just do that?
I'd go 29.9, or I'd go 30.1.
Is that final answer?
Yeah, 30%.
30.1. Okay. Shayna,
do you want to get on
this action?
Now Brian's trapped between Alex and me, so you only can win if it's right at your number. That was
right at 30.
See, you got to go last, Brian. You got to stall.
Poor guy. Shayna, you want to on this action too?
Yeah, Shayna.
What's your number?
I was going to go 31.
Oh, come on.
That's
Shayna
good.
for 31. I'm writing this down. All right. Next one's S&P 500. We all
U.S.
know
stocks, U.S. large cap stocks.
Yeah. Am I going first again? Because you guys are too scared.
I'll go -5.
Ooh, wow.
Okay.
Why? Because Trump's going to clean out and the Doge team is going to wipe out so many government jobs that there's going to be higher unemployment, and that's going to take a while to filter through the market.
I'm going to go +11.
Okay. Producer team, do you guys want to partner up on it?
I'm voting for Jason.
Oh, what? -5.
I'll go 5%.
There you go.
5?
Yeah.
All right, cool. This is kind of fun. Dow Jones.
Hey, we should throw up another slide real quick. Hold on. I'm going to tell you which one.
What slide could possibly go with this?
No, listen, it does. I got one. It's actually the same one.
Oh, okay.
Look at the same one that you had up. And when you go through the individual years on this, just looking at the up years, like 70, we got 21% is the average positive return, and a -13 is the average downside return. That's since 1926. What's amazing is the market averaged 10%, right? If you look at the S&P 500, U.S. large cap stocks. Since 1926 through the end of 2023, it averaged 10.3%. But yet very, very rarely did it land anywhere between 8 and 12%. So people think that, man, the market's really good. They all want to go chase it and get in because the average of the positive years is up 21. And then when the negative years come, it's the average of the negative is down 13. I mean, that's a far off of the average return of 10, right?
Yeah.
So
unpredictable.
It's so unpredictable in the short term and so radically predictable in the long term. It's crazy.
All right, Dow Jones.
Let's not go there. Let's go MSCI All World.
Okay.
We're going to get too, Mike. We're going to be sitting here rubbing the crystal ball for hours.
MSCI All World.
It's all stock. So that's the real proper benchmark, if you're trying to get a benchmark, unless you just are going to own companies only domiciled in the US and only large cap companies, that's what the S&P 500 is, right? It's 500 stocks. They're all US. They're all large cap. It's not a good proxy to how well are stocks doing across the world. It's not the stock market. The S&P 500 is a tiny piece of the stock market. The Dow Jones is even a tinier piece. It's US large cap value stocks, but it's only 30, the Dow 30. So, and then if you look at the NASDAQ, it's technology based or higher growth technology type companies. That's only 100. So if you put all of those together, you have 630 stocks. It's still a tiny fraction of the overall stock market. It doesn't take into account any small cap, any mid cap. It doesn't take into account any international, any emerging stocks. It's really not a good need. None of those are the stock market. They're pieces of the stock market. Whereas the MSCI All World Index is literally taking a pretty good look at how are stocks in general performing. Sorry for the dissertation
I'm plus
monologue. Up 6. I said down 5 on the other. I'm going down 6.
Oh, pessimist. Okay.
It's been too good for too long. We got it. We're due for a good punch in the face.
Yeah. That's what we tell our clients.
Well, listen, it's actually perfect because it's true. The markets don't go up forever and stay up forever. We've had a lot of positive years. The market's been really resilient and phenomenally strong, even though some people feel like it's been volatile. It hasn't. Producer Brian, on the slide right before that, page 5 of 11 on my PDF that you were just looking at, you got a bull versus bear.
2022 is pretty tough though, right? That one was
2022 was kind of ugly. And as you look, that lasted 9.2 months. Here it is on this slide.
Yeah.
We were down temporarily for 25%.
Bonds are what hurt us though, right? If you had any bond exposure,
bonds got killed. They were down 13 or 14%. It was the worst year for bonds ever in the history of all the markets. Stocks had maybe their 6th or 7th worst year, but you can look at it on this chart over towards the right end and you see that was a 25% down period. This is all S&P 500 data, so US large cap stocks. 25% down. It only lasted 9 months and, rebounded quickly. You had a quick 1.1 month blip at the start of 20. That's COVID, right? Yeah. And then if you go back to 08, of course, you had a 1 year, then a little increase, then another 2 month. So bear markets are certainly shorter, but they're punchy, right? You look at down 27, down 25, down 33, going from right to left, down 51, down 48, down 33. They're punchy. When markets correct, they correct hard and fast. And that's the big problem with trying to guess what the market's going to do, because now the market's gone down heavy and fast. You want out, you're scared, your portfolio looks terrible. You want to protect. And that's right when it turns around and recovers really quickly. It's so hard to time. And then once you get on the I second guess myself side of this equation, man, it becomes a mess. Then you just chase your tail the rest of your life.
It's like telling a lie. Once you tell a lie and you forget what the lie was, then you can't remember what you lied about and you keep lying about a lie that you don't remember what it was.
Not good.
Even worse. No, just don't even do it. Wait, Brian and Shannon didn't get to go.
Yeah,
MSCI.
They got to go. I can't wait to see this in a year. They're going to be right. We're going to be wrong. We're going to hire them as our financial advisors.
Well, I'm leaning more towards Jason on this one.
Oh, okay.
I'm pretty skeptical too.
Yeah, I got to go with Jason.
Wow. Okay. Minus what? What's your number?
5.
-5 and
let's go 6.
Oh, come on.
There you go. She just boxed you out, man. You got boxed. We got boxed out.
Story of my life.
All right, I'll scratch out the rest of them. I think those 3 are good. We got Bitcoin, S&P, and MSCI. That's a pretty good.
So we said Bitcoin's up. We said markets are down, is what I said. And again, I don't think the markets are down because the new administration isn't going to do good or because they're going to do bad. I don't really care. I do believe that what's happening economically and in the world today, we are in a much better place than we would have been if the other side won. And for global security, for safety across the globe, for respect for the US, for legal immigration as opposed to illegal immigration, reduction of crime, reducing administrative burden, and reducing government chokeholds. I mean, we have 94% of the US government employees don't go to an office. They work remote. And I can tell you from personal experience and from a lot of research on this, I would doubt that they're extremely effective working remote, 90% of our government, right? There's so much waste and so much fraud and crap that needs to be cleaned out of our government that I think we have the right administration to do that. Like or hate Trump, don't care. I don't think he's got a great loving personality, but it doesn't matter. We need somebody to run this country and to run it well. And I think the team in place to do that is really positive. So I bet the 5-year number, if we were doing 5-year predictions, I think 4 or 5 years out, we have radically low unemployment. We have much lower crime, much lower illegal immigration, a much more stable world, and the market's significantly higher in 3 to 5 years than where it is today.
And that therein is why predicting 1 year doesn't even really matter. It's fun. And it definitely, do not take any investment advice from the numbers that we just gave you, because it's purely just flipping coins and having fun. And let's start to go towards the path of closing this particular podcast and wishing everyone a happy holidays and New Year's. But I think how we started and how we got there in the middle about the importance of having a philosophy you can stick to, having a plan that is long-term. Like even you, Jason, you were like, yeah, if we're talking 5 years, I feel much better. That's how you should be thinking, not 5, but like forever. You should be thinking for your entire lifetime and build a plan for that and invest for that. Right.
Yeah. And things do change. I mean, you look back 10 years ago, we were hardly allocating to alternative investments for our clients because there wasn't really a way to do it. And now there is a way. So things do change, right? We didn't have growth as one of our fundamental factors that we implement across our portfolios 5 years ago, and we have for the last several years, and that's worked really well. So you have to stay on it. And we as financial advisors have to have a pulse on the global macroeconomic environment. And I think we're in a really great place for the global macroeconomic environment, although to cut costs is sometimes painful. That's why I hedged on the downside, right? When you go cut cost and you think that maybe 30% of our government employees aren't needed, that's a lot of unemployment, right? To filter through. Cutting costs is tough. We need to change Social Security. It was designed to support people for 5 or 10 years, and now it's supporting people for 25 or 30 years. So we have to change the age of when you get Social Security to like 75. That's so tough to do. I don't know that any political person has the political willpower to do what really needs to be done from cost cutting. And that cuts. That's painful. But in the end, you're totally right, Alex. You gotta take a longer term view. Nobody invests for 1 year or for 3 years. You're investing to solve for future liabilities. This is a lifetime. So you build a lifetime plan and then you tweak it and you massage it and you make small tweaks and massages to get that thing to really be fine tuned to your current situation, what's going on. You're not fine tuning it to the environment and trying to time the stock market. You're fine tuning it to changes that have happened, global macroeconomic changes or investment theses that have changed. That's how you can really do it well. And I got to say something, because I can't have a show without saying rebalancing, tolerance band rebalancing.
Oh no, Brian, make him stop.
No, we're not stopping.
Shayna, please.
There are ways and there are processes that you can build into a portfolio that help you trim profits when things are really good, which is what you want to do, right? Sell high. And they help you buy when things are down. And it doesn't have to be emotionally based, crystal ball, magic wand, guessing the future as the base of that. It doesn't have to be at all. You can build in processes, procedures, algorithms, trading strategies that help you sell at the top and buy when things are down. And that's what we've done at IDA and through our financial detox team. We've been able to do that in a way so we don't have to guess the market, even though we just had some fun doing it. We don't have to. Because we have algorithms.
It's not that much fun when you're wrong either.
It's so wrong. It's so not fun. And you're wrong most of the time, because what are you going to do? I mean, if the market's up next year, I'm going to look like such an idiot, right? And I got a 72% chance the market's up next year, and I bet against. I changed my bet.
I think you just did to disagree with me.
I think so.
I will say too, if you're listening to this show and you're one of the 80 to 120 clients or so that we welcome as new clients to the firm every year to do what we do, we'd love to help you with your kind of year end or beginning of year goal setting for your financial plan, build you a financial plan and show you how to actually apply all that we're talking about to your specific custom situation.
Yes, we are open for business. And the best way to do that is just get a hold of us. You can go to financialdetox.com. That'll link you into us at IDA Wealth. It's very rare. Remember when we did the portfolio challenge, the $100 portfolio challenge? We said, if it wasn't enough money, we should do the $1,000 portfolio challenge.
Whoa, nice.
But
inflation.
Inflation. We said, if we take a look at your portfolio and financial plan, and if we can't make measurable improvement in that plan, then we send you away with a $100 gift card. I don't think it was enough to get people interested.
$1,000 gift card.
But you send them away with 1,000. And we did that with, I don't know, what did we do? 20 or 30 of those?
I'd ask Thomas because he was the one that ran them and he did them. And there was only one person who actually told us very complimentary, or we told them it's actually really good, well built. And they still hired us anyways, because the guy didn't want to deal with it anymore anyways. He's like, thank you, but please take over.
He was a DIYer, do-it-yourselfer, and he had done a really good job building it. And he had a strategy and a philosophy and was disciplined and he could articulate it. Yeah. And so we're like, hey, take the money. I think we gave him the gift card and then he became a client anyway. So it worked out. But the case is, when we start talking about we're financially detox, fine, helping people, but you have to take action and you have to make sure that your advisor team is a fiduciary legally bound to work in your best interest. And you have to make sure that they're paying attention to these kind of things. They have processes and procedures so that they can trim profits when things are high and they can add to positions that are low. And that works for you. So check us out, financialdetox.com. You can send an email, jason@financialdetox.com, and we'd be happy to help you and give you a no obligation portfolio review. Look at what you're doing, see if we can benefit you. Cool. In the meantime, though, we do have to say Merry Christmas and Happy New Year. And we hope you have a wonderful holiday. We hope that financial peace of mind is yours, and it can be very easily by tuning out the noise, focusing on the things that matter, and understanding the markets. And we'll help you do that. So thanks and Happy New Year. We'll see you on the next one.